Alicia, what are you telling your clients as far as what to do with stocks this morning?
So we're saying right now that the main enemy of the market right now is uncertainty, because you can't actually model this. We've only tested 500 patients in the U.S. overall, which actually I find kind of shocking. Particularly when you think about the large communities here. But we're telling clients to take some risk off the table, because if you think about it, there's sort of a constellation of uncertainty here. There's the Democratic race, there's the course of the virus, and what the containment efforts for this do to the economy. And I'd just like to point out that the market has gone straight down since the Fed minutes came out in February 19th. And the market's basically gone down 10% since those minutes were released, where the Fed said that they're going to stop their purchases in April on the short end. And that just adds another piece of uncertainty. If you thought the market was liquidity driven, that is another piece denting it.
Art, what about you? What's your level of uncertainty around this market?
Now, Sarah, I think one of the things that you said was very interesting. We're 10% off our all-time highs. Oh, by the way, those all-time highs happened last week. So what we have to look at is how much of this correction is driven by the uncertainty over the economic damage that will clearly follow in the wake of this coronavirus, and how much of this is this market has been looking for an excuse to pull back as we've been unidirectionally higher since October of last year. And I think there's some combination of both, and it's hard to disaggregate that. But I think right now what we're forgetting is we're starting this epidemic at all-time highs, so obviously the initial damage is probably going to be a whole lot more than it has been for the other 11 global health scares that we've seen over the last 20 years. But I think the other important thing to note is in all of those other cases, 3 months and 6 months down the road, global markets were higher. We'll find containment at some point in time. We're just not anywhere close to that thought process right now.
Alicia, how do you look at history here? I mean, can you really compare it to other pandemics and the way the market reacted?
So I don't think you can compare it to other pandemics, because this tends to be just much more contagious. And also, we don't actually have a real fatality rate, a real mortality rate here. I suspect that as we get more diagnoses, the mortality rate will come down. And with that, the efforts at containment may be less severe, like what we saw in China. So then the economic activity is not so curtailed. I'll say this. We do think 6 months from now, this is behind us.
Why? How can you say that?
Because ultimately, this will run its course. I do think that if you look outside of China, the mortality rates are actually much lower. So there's suggestions in the data that as this spreads globally with better health care and better sense of warning that it's coming, that you may actually have lower fatality. And with that, I think our base case scenario is that the hit to the economy really runs its course by June, July.
So you think in that time, in 6 months, behavior adapts to a more positive picture?
I think behavior adapts because the fear will be lessened as we get more information. Now, again, not an epidemiologist. It just the data suggests that the mortality rate is much lower outside of China. So the next thing you have to ask yourself is, okay, if that happens, do we get a V-shaped recovery or do we get a U-shaped recovery? The market right now is pricing in something of a U-shape.
What if we get a W-shaped recovery?
No, you could get that also. I mean, the longer it goes on, the algorithm changes and how you price in what the recovery looks like. In the end, services will never be replaced on a one-to-one basis. You don't go to Starbucks 10 times in May because you didn't go at all in February. All those trips that are canceled will never be taken. So you could see some rebound on the manufacturing side, but less likely to see it on the services side. So you have a permanent downdraft to what your GDP and output is because of this.
So, Art, how do you approach your portfolio right now? Would you be looking to trim cyclical exposure and get more defensive? What sort of recommendations are you making?
No, I think that's a great question, Sarah. And I think the way we look at this is that first, if you're a long-term investor, you probably don't make an adjustment into this. If you're going to, I would tell you to raise cash and not to plow into defensives, because I think all of those trades are very crowded, whether you look at gold or utilities or the treasury market. But I would also tell you that, agreeing with what Alicia is saying, 6 months down the road, we'll look back and what is going to react the most violently to the upside if we get any modicum of good news and containment outside of China. China obviously is slowing down on new cases, but the global new cases will peak at some point in time and start slowing down. And I think that's interest rate sensitive. I think we see the treasuries and interest rates move higher, and I think the financials are probably the first place that you would look. I would also tell you that technology and the delayed consumption versus destroyed consumption is probably going to be the second place you want to look. Where I would avoid for a long period of time is what Alicia just brought up in the first place. Those things that won't be replaced, the permanent economic damage, the destroyed consumption, and that's all of the travel, leisure, restaurants, the gaming stocks, and I think they're going to be underwater for the balance of this year.
Do you agree with Art that the safety plays are getting too expensive and you should avoid them? Gold, treasuries, I don't know, Clorox is up 7% so far this month. And people are willing to pay a price, and a heavy price, to get in safe spots.
So if you have fresh capital, you should be suspicious of this, right? We know there will be some reversion to the mean, and if the play already happened and you weren't there, you probably missed it, is our take on this. But, to what Art said, this is really interesting because this is a supply shock as well. And that's, what the market is pricing in is that in the end, central banks may not be able to do anything about the supply side. So in the end, easier policy helps the demand side, but it's the supply side and the destroying of supply chains and what that does to manufacturing. So it really is a multifaceted problem. It's just not a linear thing where you throw this in, okay, we have a recovery in April and it's fine. It has tentacles.
Have we ever had a supply shock like this?
We've had supply shocks, like, for instance, in the oil market, right? So you've had something like that in the past. What this will do, if the worst case scenario happens, then what you'll wind up having is an acceleration of the trend towards deglobalization and more nationalist economic policies, which you really saw over the last couple of years since the peak trade year of 2017.
And Art Politico has got a piece on that, how Navarro, they argue, is trying to seize the moment, in their words, and accelerate that migration of supply chains. But isn't that inflationary by its very nature?
Yeah, it's also impossible to do in the short run. We've seen that since the beginning of the trade war. Everyone's trying to unwind some of their complex supply chains, but you just can't do that. We've built these up over 2 decades. We can't change that over 2 years. I think where our biggest exposure to that is actually showing itself in this particular epidemic is in pharmaceuticals and pharmaceutical production being so concentrated in China, in a place that we'd never thought would be shut down for a month at a time. So I think that's it, but I think everything else just takes time. If you want to disentangle some of your supply chains from a single place, that's been happening over the last couple of years. It just takes much longer to unwind that. It's easy to say, but it's much harder to do in real time.